Welcome to the Series 65 Exam Prep course, your definitive guide for mastering the NASAA regulatory landscape and achieving your certification. We will examine the exam structure, registration requirements, and ethical standards essential for your success. This content is for informational and entertainment purposes only and does not constitute financial, legal, or tax advice. Always consult a qualified professional before making financial or legal decisions. This course is an unofficial, independently produced prep guide and is not affiliated with, endorsed by, or connected to NASAA or any official exam provider. All trademarks belong to their respective owners. This course is designed to provide you with a structured, clear, and professional path to passing the Uniform Investment Advisor Law examination. You will gain a thorough command of the Uniform Securities Act, federal legislative history, and the fiduciary responsibilities that define your role as an investment advisor representative. By navigating through the regulatory framework and ethical standards, you will move beyond rote memorization to a conceptual mastery of the material. This is not about guessing. It is about building a reliable mental model of the laws and guidelines enforced by NASAA. Investing your time here is the most efficient way to ensure you are fully prepared for the complexities of the official examination. Our roadmap begins with the fundamental legal framework and progresses through the intricate responsibilities expected of investment professionals. We will categorize key concepts, from registration procedures to the nuances of fiduciary duty, ensuring that each lecture builds upon the last. You will learn to navigate the interplay between state and federal jurisdictions, particularly under the influence of NSMIA, which redefined how we coordinate regulatory compliance. We will also focus on the psychology of testing, helping you develop strategic note-taking habits, effective time management, and the ability to dissect complex questions. Each module is crafted to align with the official exam objectives, providing a comprehensive curriculum that mirrors the real-world requirements of the industry. By the end of this curriculum, you will possess the clarity and confidence required to transition from a student into a qualified investment advisor representative. We focus strictly on the hard facts and the logic behind legal definitions to eliminate the ambiguity that often causes candidates to stumble. This course is for those who value a disciplined, logical approach to their professional education and want to avoid the common, costly pitfalls of disorganized study. Every lesson adheres to the core mandates of the Uniform Securities Act, ensuring that your study time is productive and focused solely on what the examiners deem critical. I invite you to commit to this rigorous structure as you prepare for your path towards certification. I look forward to starting this journey with you in the next lesson. Welcome to the opening chapter on the Uniform Securities Act, where we will build the essential legal foundation required for your examination success. This module serves as your primary gateway to mastering the complex regulatory landscape that dictates professional conduct in the securities industry. The Uniform Securities Act, or USA, functions as the blueprint for state-level securities regulation, often referred to as blue sky laws. These laws were designed to protect investors from unscrupulous practices by standardizing how securities are sold and how professionals operate within state borders. Because individual states have the authority to create their own unique versions of these regulations, the USA provides a necessary model to promote consistency across jurisdictions. However, the balance of power shifted significantly following the National Securities Markets Improvement Act, or NSMIA, in 1996. This federal legislation was intended to eliminate the burden of dual regulation by streamlining the oversight of investment advisors and market professionals. Under federal preemption, certain classes of securities and market participants are now largely regulated at a federal level, effectively bypassing state-level registration requirements for specific advisors. Understanding the intersection between state authority and this federal preemption is the cornerstone of passing this exam. Before we dive into the granular details of regulation, it is imperative that we understand the legal concept of a person, which is defined quite broadly under the Act. For regulatory purposes, a person is not limited to natural human beings, but also encompasses a wide array of legal entities. This definition includes corporations, partnerships, associations, joint stock companies, trusts, and even estates or governments. Recognizing this distinction is vital because when we discuss registration requirements for firms or individuals, the Act applies these labels consistently to both business clusters and physical people. If an entity meets the criteria of being a person, it falls under the watchful eye of the state administrator. Whether it is a solo investment advisor or a sprawling global corporation, the regulatory expectations regarding transparency and ethical behavior remain uniform. This broad definition ensures that no artificial entity can circumvent the law simply by organizing under a specific business structure. By treating these diverse organizations as legal persons, the regulators maintain a consistent framework for oversight. The concept of an issuer is equally fundamental to your understanding of how securities are created and brought to the marketplace. An issuer is essentially any person whom issues or proposes to issue a security, regardless of whether that security is intended for the public or a select group of private investors. This definition is restricted in scope when we consider who is actually collecting the proceeds from a securities sale. A non-issuer transaction is one that is executed for the benefit of someone other than the issuer, such as a typical trade occurring between two market participants on a stock exchange. This clarifies why secondary market activity is treated differently than an initial public offering under the regulations. In an IPO, the issuer receives the capital directly, triggering rigorous disclosure and registration requirements. Conversely, in a secondary market transaction, the issuer is not the recipient of the funds, which often leads to different exemptions or relaxed reporting standards for the persons involved. We must constantly track who is on the receiving end of the capital to determine the appropriate regulatory treatment. We will also explore the distinct roles of broker-dealers and agents, which represent the primary intermediaries in the financial landscape. A broker-dealer is a person engaged in the business of effecting securities transactions for the accounts of others or for its own proprietary account. If an entity is buying and selling stocks for its own portfolio as a routine business practice, it is a dealer, whereas executing trades for clients categorizes it as a broker. Agents, by contrast, are individuals, often known as representatives, who represent a broker-dealer or an issuer in the process of effecting or attempting to effect purchases or sales of securities. It is impossible to qualify as an agent if you are not a natural person, unlike the broker-dealer category, which typically consists of firms. Distinguishing between the firm and the individual working for that firm is a common point of confusion that we will systematically dismantle. This helps you identify the specific registration thresholds and reporting obligations that apply to both personal and organizational conduct. As we move through these materials, remember that the administrator wields significant influence over the conduct of registrants within their state. These authorities range from the power to issue subpoenas and mandate hearings to the ability to initiate civil penalties or pursue criminal liabilities for those who willfully violate the statutes. Understanding these powers is not just an academic exercise. It is the core of how the state maintains the public interest standard. We must look at how the administrator interprets these laws, often through advisory opinions, to anticipate how they might respond to various professional scenarios. The statute of limitations for these actions is a critical detail that often appears on the exam, as it delineates how long regulators have to pursue an individual for past transgressions. Our goal is to synthesize these legal elements into a coherent mental model that allows you to predict how the law applies in any given situation. By mastering these definitions and powers, You are positioning yourself to navigate the regulatory environment with complete confidence. I will see you in the next lecture as we continue to build your expertise. Welcome back. In this lesson, we will parse the precise statutory definitions of investment advisors and investment advisor representatives to ensure you understand exactly who falls under regulation. To understand whether an entity is an investment advisor under the Uniform Securities Act, we apply the classic three-prong test. First, the entity must provide advice regarding securities. This is not limited to stocks and bonds, but extends to any instrument that qualifies as a security under the regulatory framework. Second, the entity must be in the business of providing this advice. This implies a level of regularity and continuity rather than isolated or sporadic instances of commentary. Finally, the entity must receive compensation for these services. Compensation is defined broadly to include any economic benefit, such as advisory fees, commissions, or other indirect forms of payment. If an entity meets all three of these criteria, providing advice, doing so as a business, and accepting compensation, it is presumed to be an investment advisor unless a specific exclusion applies. Exclusions from the definition of an investment advisor are critical because they dictate who escapes the registration requirement entirely. Banks, savings institutions, and trust companies are generally excluded, provided their advisory activities are incidental to their primary business. Lawyers, accountants, teachers, and engineers, often referred to as the late professionals, are excluded only if their advice is wholly incidental to the practice of their profession and they do not charge separate, identifiable fees for that specific investment advice. Publishers of bona fide newspapers, news magazines, or financial publications of general and regular circulation are also excluded. Furthermore, broker-dealers who provide advice incidental to their brokerage business and do not receive special compensation for that advice fall outside the regulatory reach of investment advisor statutes. These exclusions are narrow, and any hint of charging for advice outside of the normal professional scope typically triggers the requirement to register. Once we have established the definition of an investment advisor, we must turn our attention to the investment advisor representative. A representative is any partner, officer, director, or other individual employed by an investment advisor who performs specific functions. These functions include making recommendations or providing advice regarding securities, managing client portfolios, or soliciting, offering, or negotiating the sale of investment advisory services. Supervision is also a key component. Individuals who supervise those performing the aforementioned tasks are themselves classified as representatives. The definition effectively captures everyone who has direct client contact or decision-making authority within the advisory structure. Understanding this distinction is vital because, while the firm registers as the investment advisor, the individuals acting on its behalf must register as representatives, unless they fall under specific administrative or de minimis exemptions. The regulatory landscape distinguishes between the registration requirements for the firm and the individuals involved. An investment advisor firm registers based on assets under management, whereas an investment advisor representative generally registers at the state level where they maintain a place of business or have a sufficient number of client contacts. There is an essential difference between an associated person and a supervised person, with the latter focusing on the internal reporting structure of the firm. Furthermore, firms must be mindful of solicitation arrangements, where third parties are compensated for referring clients, as these arrangements trigger additional disclosure and registration responsibilities. You must also consider the de minimis standard, which allows certain advisors to avoid registration in a state if they lack a physical location and fall below specific client count thresholds. The complexity lies in the intersection of these definitions, as one individual could theoretically perform functions that trigger requirements under both state and federal frameworks, depending on the firm's assets under management and the nature of the clients. See you in the next lecture. Welcome back to our journey through the Uniform Securities Act. In this session, we will demystify the legal definitions of securities and explore the specific categories of exemptions that you must master for your exam. To understand the regulatory landscape, we must first establish what constitutes a security, and the courts have provided us with a functional framework known as the Howey test. The test identifies a security as an investment of money in a common enterprise with a reasonable expectation of profits to be derived primarily from the efforts of others. This is a broad definition designed to catch virtually any arrangement where an investor puts capital at risk with the hope of gain, including common stock, preferred stock, bonds, options, and variable annuities. Even modern digital assets have been increasingly scrutinized under this lens, provided they meet these four foundational criteria of the investment contract. When you evaluate an instrument on the exam, you should always return to these four pillars to determine if the regulators would classify the asset as a security. A common trap is to assume that because an item is not explicitly listed in the statute, it cannot be a security, but the Howey test is intended to cover new and creative financial instruments. Once we acknowledge that an instrument is a security, we must determine if it is exempt from the state registration requirements to avoid unnecessary regulatory burdens. Exempt securities are generally deemed low risk or already subject to oversight by other federal or state bodies, such as Treasury issues or municipal bonds. Bank issues, certain commercial paper, and offerings by nonprofit organizations often fall into this category as well. However, for commercial paper to be exempt, it usually must have a high rating, a short maturity period, and a specific denomination limit to ensure it is intended for sophisticated institutional buyers rather than retail investors. These exemptions are not always permanent, and the administrator maintains the power to revoke or deny certain exemptions if they believe it is in the public interest to protect investors. Remembering the difference between an exempt security and an exempt transaction is critical, as one is inherent to the type of instrument and the other is based on the nature of the sale itself. When we shift our focus to exempt transactions, we're looking at specific circumstances, such as isolated non-issuer transactions, which allow for selling securities without full registration if the activity is truly infrequent. Another vital area involves private placements, often structured under Regulation D, which define the requirements for selling securities to accredited investors who meet stringent net worth or income thresholds. Fiduciary transactions, such as those executed by trustees or executors, are also exempt because they are already performing duties under a court or legal oversight. Institutional buyer standards are applied here to distinguish between professional entities that can fend for themselves and retail clients, who require the full protection of a prospectus and rigorous state review. Furthermore, unsolicited orders, where the client approaches the agent, are typically exempt because the agent did not initiate the solicitation, which keeps the regulatory concern regarding aggressive sales tactics at bay. The burden of proof regarding an exemption always rests squarely on the person claiming it, meaning you must be diligent in documenting why a specific transaction or security does not require registration. Closely related to these concepts are federal covered securities, a designation created by the National Securities Markets Improvement Act of 1996, which effectively preempted much of state law for national offerings. This group includes securities listed on major exchanges and those issued by companies registered under the Investment Company Act of 1940, such as mutual funds and ETFs, which already face meaningful federal scrutiny. While these issuers do not need to register by coordination or qualification in every individual state, they may still be required to provide a notice filing and pay state filing fees. This dual system serves to harmonize the regulatory environment while preserving the state administrator's role in fraud enforcement and fee collection. Keeping these definitions clear will ensure you can categorize any scenario the exam throws your direction with confidence. If an issuer does not qualify for an exemption, they must navigate the state registration process, which can be accomplished through notification coordination, or qualification. Registration by notification is generally reserved for established issuers with a history of earnings, while coordination allows an issuer to sync their state filing with their federal registration under the Securities Act of 1933. Registration by qualification is the most demanding path, used primarily for intrastate offerings that must meet the specific, often rigorous, standards of the individual state administrator. Regardless of the path chosen, the administrator may set limits on selling expenses, require proceeds to be held in escrow, or mandate the delivery of a prospectus to ensure the client is fully informed before committing funds. Underwriters may also find themselves subject to legal opinion requirements and audits of their financial statements to verify the accuracy of the disclosures made in the registration materials. Maintaining compliance with these mandates is a central administrative concern that, if ignored, leads to severe consequences for the issuer and the agents involved. I will catch you in the next one. Welcome back. In this chapter, we will examine the administrative requirements investment advisors and their representatives must navigate to maintain valid registration status. Registration for investment advisors begins with the filing of Form ADV through the Investment Advisor Registration Depository, commonly known as the IRD, while representatives complete their registration via the Central Registration Depository, or CRD. Form ADV itself acts as a comprehensive disclosure document, divided into various parts that detail the firm's business practices, fee structures, disciplinary history, and any potential conflicts of interest. When an advisor applies for registration, they must also submit a consent to service of process, which is a legal document appointing the state administrator as the agent for service of process. This ensures that if a legal action is brought against the firm, it can be served effectively within that jurisdiction. Financial condition disclosure is another critical component, particularly for firms that maintain custody of client assets or charge substantial prepayment of fees. In some states, applicants must meet specific net capital minimums to demonstrate their fiscal responsibility to the public. If a firm meets the threshold for custody, they are often required to provide an audited balance sheet as part of the initial application package to ensure transparency. Furthermore, state-specific requirements may dictate that an advisor post a surety bond to protect clients in the event of insolvency or fraud. The definition of custody is nuanced, particularly regarding the concept of inadvertent custody, which occurs when an advisor inadvertently receives client funds or securities. Inadvertent custody is generally deemed to have occurred if those assets are not returned within 3 business days, although firms can avoid this classification by having strict procedures to forward checks or securities to the qualified custodian. Physical possession of client funds or securities imposes heavy regulatory burdens, including the requirement for annual surprise audits by an independent public accountant. Record keeping is another pillar of the regulatory framework, requiring investment advisors to maintain specific books and records for set durations. Generally, records must be kept in the principal office for the first 2 years of their retention period, often totaling 5 years in standard practice. These records must be readily accessible, and electronic storage is permitted provided that the information is tamper-evident and capable of being reproduced in a legible format. Investigators must be able to verify that the firm remains in compliance with these technical standards during any regulatory audit. Individual registration for investment advisor representatives involves the Form U-4, which tracks an individual's professional history, including employment disclosures and residential addresses. This process necessitates a thorough background check, which includes the submission of fingerprints to the FBI to screen for criminal activity. Applicants must disclose any felony charges or securities-related misdemeanors, as these often trigger a statutory disqualification from registration in the financial industry. If a registration is denied, revoked, or suspended, it is usually because the applicant falls short of these statutory standards regarding integrity and ethical behavior. When a representative leaves a firm, The firm must file a Form U-5 within 30 days to terminate the registration, necessitating a clear reason for the departure. Special provisions exist for military service members, allowing for the expiration of certain grace periods that preserve registration status while the individual is on active duty. Renewal of registration is typically handled on an annual basis, requiring the payment of fees to keep the license active across various jurisdictions. Succession of ownership also follows strict rules, where a successor firm may file an application for registration to succeed the previous entity without necessarily having to pay a new filing fee. Amended filings are mandatory whenever there is a material change in the firm's business, such as a shift in management or a new discovery of conflicts of interest. Regulators require prompt notification of these changes to ensure that the information available on the IRD system remains accurate for potential clients. Beyond the initial filing, firms must adhere to the brochure delivery rule, which dictates the timeline for providing clients with the firm's disclosure document. Clients must receive the brochure either before or at the time of entering into an advisory contract, with annual updates provided subsequently. This ensures that the client remains informed about the firm's evolving business practices throughout the duration of the professional relationship. Maintaining these documents and ensuring timely delivery is a fundamental baseline for operational compliance within the investment advisory space. Take care until we meet for our next topic. Welcome. In this chapter, we will examine the regulatory framework governing broker-dealers and their agents to help you master the nuances of the Series 65 exam. To understand the regulatory landscape, we must first define a broker-dealer as any person engaged in the business of effecting transactions and securities for the account of others or for their own account. The primary identifier is transaction-based compensation, which functionally separates a broker-dealer from an investment advisor who typically charges asset-based fees. If a firm maintains a place of business in a state or has even one retail client residing there, it must generally register as a broker-dealer in that jurisdiction. However, exclusions exist, such as for firms with no office in the state that only deal with other broker-dealers, banks, or insurance companies. An intrastate exemption applies if all offices are in one state and all business remains within those borders, though federal oversight often supersedes this in practice. Foreign broker-dealers may be excluded if they have no office in the state and limit their activities to institutional clients or existing customers temporarily visiting the state. Understanding these boundaries is critical because the definition of a broker-dealer is broad, capturing almost any entity that derives profit from the act of trading securities for others. While the broker-dealer is the firm, the agent is the natural person who represents the firm in effecting or attempting to effect security transactions. An agent, often referred to as a registered representative, must be registered in every state where they solicit business or originate transactions. The definition is distinct when an individual represents an issuer rather than a broker-dealer, especially in new issues or distribution of securities. Compensation is the major trigger here. Receiving commissions or transaction-linked pay usually mandates registration. There are specific exceptions for agents representing an issuer in exempt securities, such as government bonds or commercial paper, or in exempt transactions, such as deals strictly between issuers and underwriters. Furthermore, employees of an issuer who assist in employee benefit plans or stock option plans may avoid agent registration if they receive no commission-based pay. These distinctions prevent unnecessary regulatory burdens while ensuring that those directly soliciting the public for profit remain under state supervision. Once an agent is registered, the regulatory burden shifts to maintaining compliance and robust record-keeping practices. Firms are required to maintain blotters, general ledgers, and order tickets for a duration typically set at 3 years, with the first 2 years kept in an easily accessible place. These records must accurately reflect every transaction, including the time of entry, the account involved, and the specific security details to ensure an audit trail exists for regulators. Net capital standards are strictly imposed to ensure that firms remain solvent enough to meet their obligations to clients and the markets. These requirements are standardized under the Uniform Securities Act to ensure that a firm's financial health is transparent and consistent across state lines. If a firm fails to maintain the required net capital, it must immediately notify the administrator, as this constitutes a significant risk to the investing public. Prohibited practices are a significant portion of the exam, as the regulator seeks to curb misconduct that harms retail investors. Churning or excessive trading in a client account to generate commissions is a flat violation of the agent's fiduciary and ethical obligations. Markups must also be fair and reasonable rather than predatory, keeping in mind the prevailing market conditions at the time of the transaction. Commingling client funds with firm funds is strictly forbidden, as is the act of lending money to clients unless the firm is a bank or the client is an affiliate. Hypothecation, which involves pledging client securities as collateral for a firm's own loans, requires signed consent from the client through a formal hypothecation agreement. Commission splitting is only permitted between registered agents of the same broker-dealer or affiliated firms, and sharing in the profits or losses of a client account is generally prohibited unless specific written authorization and proportional contribution are present. Margin accounts present their own complexity because they introduce leverage and credit risk into the client relationship. Before a margin account is opened, an agent must obtain a signed credit agreement, which details how interest is calculated and how the firm charges for the loan of funds. A separate loan consent document is typically required if the firm intends to lend the client's margin securities to others. Discretionary authority is another critical area, requiring the client to provide written authorization to the broker-dealer before the agent can decide the time or price of a trade without prior consultation. Custody definitions are vital here, as holding client funds or securities creates an elevated standard of care and specific reporting requirements. Maintaining these standards ensures that the agent acts as an honest broker, prioritizing the client's interests over the potential for short-term gains through manipulative or overreaching practices. See you in the next lecture. Welcome back. We are now turning our attention to the administrative powers and the regulatory remedies that state administrators wield under the Uniform Securities Act. In this chapter, we will dissect how authorities manage compliance, investigate misconduct, and enforce legal boundaries within their jurisdictions. The state administrator holds a significant scope of authority that is primarily triggered by acts involving offers to buy or sell securities within their state. Jurisdiction is established when an offer originates in the state, is directed into the state, or is accepted within the state, often creating situations where multiple administrators might have simultaneous oversight. An administrator has the power to conduct investigations at any time, even if no explicit violation has occurred yet, simply to gather facts or determine if a law is being broken. During these investigations, they possess the power to administer oaths, subpoena witnesses, compel the production of evidence, and seek court-ordered enforcement if a party demonstrates noncompliance. If an individual fails to obey a subpoena, the administrator can apply to a court of competent jurisdiction to hold that person in contempt of court. These broad investigative powers ensure that the administrator remains the ultimate watchdog tasked with maintaining fair and ethical markets for the investing public. When a violation of the Uniform Securities Act is uncovered, the administrator can issue cease and desist orders, which serve as immediate directions to halt and prohibited practice. While these orders can be issued without a prior hearing, the affected party typically has the right to request a hearing to challenge the administrator's findings. Furthermore, the administrator can deny, suspend, or revoke a registration if they find such action is in the public interest and is supported by a finding of fact confirming that the registrant violated the act. This standard of proof is essential to ensure that any disciplinary action against a professional is not arbitrary, but is rooted in documented rule-breaking. In many cases, the revocation of a firm's registration leads to automatic consequences for the registered representatives associated with that firm, emphasizing the importance of compliance oversight. All such actions are subject to the principles of public disclosure, as disciplinary history is often made available to protect prospective clients from interacting with unscrupulous professionals. Civil liabilities provide a pathway for clients to recover losses when an investment professional fails to adhere to the requirements of the law. A client may be offered a rescission, which allows them to essentially undo the transaction and recover the original purchase price plus interest and attorney fees, minus any income already received from a security. The statute of limitations for these civil actions is strictly defined as the earlier of 2 years from the discovery of the violation or 3 years from the actual date of the occurrence. If a firm or individual makes a formal offer of rescission, the client must accept or reject it within a specific time frame, as failure to act waives their right to sue for that specific event later. These provisions are designed to make the harmed party whole again while simultaneously incentivizing adherence to regulatory statutes through the threat of financial reversal. It is important to note that civil liability essentially balances the scales for investors who were misled or treated unfairly during the advisory process. Criminal penalties represent the most severe consequences under the Act and are specifically reserved for willful violations of provisions or rules. Unlike civil liabilities, which focus on monetary compensation, criminal penalties focus on punitive measures, such as significant fines or terms of imprisonment. A key nuance in the criminal context is the no-knowledge defense, which allows a respondent to avoid imprisonment if they can prove they had no actual knowledge of the specific rule or order that was violated. However, this defense does not provide immunity from fines or other regulatory sanctions, as the professional responsibility to know the rules remains paramount. The process of challenging an administrator's order involves a formal appeal through the judicial system, known as judicial review. During this review, an order might be stayed or overturned, but until that point, the administrator's final order generally retains the force of law. The regulatory framework is further strengthened by cooperation, as the Uniform Securities Act encourages administrators to share information across state lines and coordinate with federal authorities. This collaborative approach allows enforcement task forces to tackle complex fraud cases that cross regional boundaries, ensuring that an unscrupulous actor cannot simply move to another jurisdiction to continue their activities. By aligning standards and sharing findings, administrators effectively create a unified front that complicates the lives of those who attempt to bypass the law. This cooperative spirit is often manifested in the adoption of NASAA model rules, which provide a consistent set of interpretive guidelines for state offices to follow. Throughout this process, administrators must balance their enforcement duties with a need for fairness, ensuring that every disciplinary action can withstand the scrutiny of a legal challenge. Ultimately, these administrative remedies serve as the backbone of investor protection, ensuring that the securities industry operates with a high degree of transparency and accountability. I will see you in the next lecture. Welcome to a new discussion where we will explore the nuances of investment advisory contracts and fee structures. This chapter is designed to provide you with a comprehensive understanding of regulatory mandates that govern how advisors interact with clients financially. When we approach the construction of an advisory contract, we must view it primarily as a legal instrument governed by the Uniform Securities Act and the Investment Advisors Act of 1940. The fundamental rule is that all investment advisory contracts must be in writing, which serves to protect both the firm and the client by establishing clear expectations. Within these documents, you must explicitly state the services to be provided, the term of the agreement, and the fee schedule that will be applied. A critical component mandated by regulators is the prohibition against assigning the contract without the client's express written consent. In this context, an assignment is defined as any transfer of the contract by the investment advisor, including the indirect transfer of a controlling block of the advisor's voting securities. If a firm operates as a partnership, the contract should also include provisions regarding the notification of any changes in the composition of the partnership, specifically if a minority interest changes hands, as this may technically constitute a change in control. Fee structures are a frequent point of scrutiny for regulators, particularly regarding performance-based compensation. The general rule is that performance fees are prohibited because they can incentivize an advisor to take undue risks with a client's portfolio to chase higher returns. However, there is a distinct exception known as the fulcrum fee, which is a performance-based arrangement where the fee increases or decreases proportionately with the investment performance of the client's account against an appropriate index. To qualify for specific performance fee arrangements, the client must be classified as a qualified client. A qualified client is generally defined as an individual or company that has at least $2 million in net worth or at least $1 million under management with the investment advisor. These thresholds are meant to ensure that only sophisticated investors who can ostensibly understand the risks inherent in performance-based incentive allocations are entering into these types of arrangements. Another common arrangement you will encounter is the wrap fee program, where a bundle of services including brokerage, advisory, and custodial services are provided by the firm for a single fee. Because this structure can mask the cost of individual services, the regulation requires specialized disclosure mechanisms. An investment advisor offering a wrap fee program must provide a specific document known as Form ADV Part 2, A Appendix 1, often referred to as the wrap fee program brochure. This document must clearly disclose the nature of the bundled services, the total cost involved, and whether the fees charged are reasonable when measured against industry averages for similar services. You have a fiduciary duty to ensure that if you're charging a client through a wrap fee, they're not being effectively penalized by paying for services they do not utilize, such as excessive trading or unused institutional research. The goal here is complete transparency so the client can make a rational decision about whether the convenience of the bundle outweighs the potential cost premium. The logistics of billing also carry strict requirements regarding timing, refunds, and transparency. Most firms bill fees in advance, meaning the client pays for the management services that the firm is about to perform for the upcoming quarter. If the client decides to terminate the relationship mid-quarter, the firm must have a clear refund policy to return the unearned portion of the prepaid fees. If the contract is silent on this matter, or if the policy is ambiguous, firms often face regulatory pushback. Any contract must also outline the termination procedures, which informs the client exactly how and when they can cancel the agreement, usually with written notice. Furthermore, contracts often contain language regarding automatic renewal, but you must ensure these clauses do not trap a client into an involuntary extension of the contract. Clarity in execution is paramount, and obtaining a client's signature is not just a best practice, but a legal requirement to ensure that both parties are bound by the same set of understood contractual obligations. Finally, we must address the variety of alternative fee arrangements that firms might implement, such as fixed fees, hourly rates, or tiered percentages based on assets under management. Regardless of the method, the advisor must clearly document how the fee is calculated and whether expenses, such as third-party custodial costs or solicitor fees, are included or charged separately. If an advisor receives compensation from a third party for referring a client to a service, this constitutes a conflict of interest that must be fully disclosed to the client. The reasonableness of these fees is relative to the expertise provided and the complexity of the client's financial situation. You must avoid any scenario where fee structures incentivize unethical trading practices, such as churning an account to generate transaction-based commissions. By maintaining rigorous documentation and clear, itemized billing, you uphold the standard of care expected of an investment professional. See you in the next lecture. Welcome to our deep dive into the standards governing how you communicate with clients and the public. We will explore the rigorous requirements for advertising, social media, and professional disclosures to ensure you remain compliant with NASAA regulations. In the professional landscape, an advertisement is broadly defined as any communication sent to more than one person or to one or more persons that offers investment advisory services with regard to securities. This includes any notice, circular, or letter, whether sent through print, digital, or social media channels. When navigating the distinctions between static and interactive content, the regulatory concern remains consistent, preventing any form of communication that could be construed as misleading or deceptive. Static content, such as a permanent web page or a fixed brochure, is viewed as a controlled advertisement subject to pre-approval and record-keeping protocols. Interactive content, like real-time posts on X or LinkedIn, poses unique challenges, yet it still falls under the umbrella of regulated communications that require stringent internal oversight. Your firm must establish clear workflows to monitor these interactions, as accessibility often invites higher scrutiny from regulators who demand that all client communication adheres to the highest standard of transparency. Historical performance data often serves as a point of contention during examinations because it is inherently susceptible to manipulation. When presenting performance, you must distinguish clearly between gross and net of fee returns to ensure the reader understands the impact of management expenses on their bottom line. A balanced presentation is non-negotiable. For every instance of past success, you must include a prominent disclosure of the risks involved. You cannot highlight a portfolio's gains without providing context on the specific market environment or benchmarks used during that period. Furthermore, using charts, tables, or graphs requires extreme caution, as these visual aids must not oversimplify complex investment cycles or obscure potential downturns. NASAA expects that a client reading your promotional material gains a realistic expectation of investment outcomes rather than an idealized projection of hypothetical growth. Prohibitions regarding testimonials and third-party ratings are central to maintaining the integrity of our industry. Historically, testimonials from clients were outright prohibited in investment advisor advertising, but current rules allow for them under specific, heavily regulated conditions. If you choose to feature an endorsement or a rating, you must disclose whether the person is a client, if they were compensated, and if there are any material conflicts of interest. Blind endorsements, or those lacking clear attribution, are strictly forbidden because they violate the foundational requirement of clarity and honesty. Regarding professional designations, you are only permitted to use titles that are legitimate and verifiable, such as CFA, CHFC, or CFP. Claiming a pseudo-designation or misrepresenting the meaning of a recognized credential to imply a level of expertise you do not possess is a fraudulent practice that will lead to severe disciplinary action. When we look at the standards for retail versus institutional communication, the level of disclosure required differs based on the sophistication of the audience. Retail communication is addressed to more than 25 non-institutional persons within a 30-day period and is subject to comprehensive pre-approval processes by a designated supervisor. Institutional communication, addressed to banks, investment companies, or large accredited entities, allows for a more streamlined approach, but does not exempt the firm from the duty to avoid inaccuracies or omissions of material facts. Every piece of written material, whether digital or physical, must be archived according to firm policy, usually for a period of 5 years. These approval logs and archival records are not merely bureaucratic hurdles. They're the evidence required to prove that your firm maintains a culture of compliance and respects the fiduciary duty owed to every investor. See you in the next lecture. Welcome to this exploration of discretionary authority and custody, two pillars of regulatory compliance that define the boundary between an advisor's autonomy and their role as a fiduciary steward. In this chapter, we will unpack the mechanics of managing client assets while maintaining the rigorous standards required by the Uniform Securities Act. Discretionary authority exists when an investment advisor holds the power to decide which assets to purchase or sell, the specific amount to be traded, or the overarching action taken on behalf of a client, without needing prior consultation for every transaction. If an advisor only has the authority to decide the time or price for an execution, often called time and price discretion, this is generally not considered full discretionary authority, though it must still be documented carefully. To exercise broader control, the advisor must have written authorization from the client, typically established through a signed power of attorney or a specific discretionary trading mandate. While some jurisdictions allow for oral discretion in limited, short-term scenarios, this is an exception rather than the rule, and it often expires after 10 business days unless followed by a written agreement. This mandate must align strictly with the client's investment policy statement, ensuring that the advisor's decisions serve the client's objectives rather than the advisor's own preferences. A limited power of attorney allows the advisor to trade, whereas a full power of attorney might grant broader control that could include the withdrawal of funds, which shifts the nature of the relationship significantly. Custody, on the other hand, is defined more broadly than simply holding physical certificates, as it essentially means having legal title to or the ability to access client funds or securities. Inadvertent receipt of client funds, such as an incorrectly addressed check, does not constitute custody if the advisor returns those funds to the sender within 3 business days. However, if an advisor maintains that check or has direct access to a client's accounts, they are deemed to have custody and are subject to stringent oversight. Regulations mandate that such assets must be held by a qualified custodian, which is usually a bank or a registered broker-dealer, to prevent commingling with the firm's own operating capital. If an advisor finds themselves in a position of having custody, they must notify the state administrator via Form ADV and ensure they are meeting heightened bonding requirements. Furthermore, those who hold custody must undergo an annual surprise audit conducted by an independent certified public accountant who reports the findings directly to the state regulatory office. The delivery of account statements is a critical control mechanism designed to provide transparency for the client when an advisor holds or has access to their assets. Whether the qualified custodian or the advisor delivers these statements, the frequency is mandated by rule, generally requiring monthly delivery if there has been activity and quarterly delivery at the absolute minimum for all accounts. If the advisor has the capability to deduct fees directly from a client's account, this act is legally treated as custody, necessitating a clear invoice delivery system that allows the client to reconcile charges against the statements provided by the qualified custodian. Any material discrepancy detected between the advisor's records and the custodian's reports must be resolved and reported according to strict regulatory timelines. Firms must ensure they are not commingling client securities with proprietary assets, as physical stock certificates must be segregated and protected under safekeeping procedures. These requirements are not merely suggestions, but foundational rules that prevent the misappropriation of assets and maintain the integrity of the investment advisor's fiduciary duty. I will see you in our next session. Welcome back. Today we are diving into the critical realm of disclosure and policy requirements, a fundamental pillar for any investment advisor operating under the NASAA framework. The cornerstone of the advisory relationship is the Form ADV Part 2, commonly known as the brochure. Investment advisors are mandated to provide a written disclosure document to clients that offers a transparent view of their business operations. You must deliver this brochure to prospective clients either at or before the time you enter into an advisory contract. There is a specific nuance regarding the cooling off period if you deliver the brochure at the time of signing. If the client receives the brochure at the moment they sign the contract, they must be granted a 5-day right to rescind that agreement without penalty. This ensures that clients have the opportunity to review the document and walk away if the disclosed practices, fees, or background do not align with their expectations. Failure to provide this disclosure at the appropriate time is a direct violation of regulatory standards. These documents serve as the primary mechanism for informed consent between the fiduciary and the invested party. Once the initial relationship is established, the advisor has an ongoing duty to provide updates. You are required to deliver an annual updating amendment to all existing clients within 120 days after the end of your firm's fiscal year. This update must include a summary of any material changes that have occurred since the last brochure delivery to ensure clients remain fully informed. The Form ADV Part 2 is highly structured, requiring disclosure across several specific sections, such as your company profile, disciplinary history, fee schedules, and business practices. You must also detail the management team's background and educational standards to provide clients with a clear picture of who is directing their investments. Conflicts of interest must be explicitly laid out, and if the advisor has custody of client funds or demands prepaid fees of a certain threshold, the firm must include a copy of its audited balance sheet. Transparency is not optional. It is the regulatory minimum for maintaining a valid registration and serving the public trust. Beyond the brochure, firms must adhere to Regulation SB, which governs the privacy of consumer financial information. You are legally required to provide clients with a clear privacy policy notice that describes your data collection and sharing practices. This notice must inform clients of their right to opt out of having their non-public personal information shared with certain non-affiliated third parties. When it comes to data security, advisors must implement robust identity verification standards and employ technologies like encryption to protect sensitive client records. Your internal controls are expected to safeguard against identity theft and unauthorized access to financial accounts. The regulatory expectation is that you will treat client data with a level of care consistent with a high sensitivity of their financial identity. These security measures are not just good business etiquette. They are explicit requirements under federal and state privacy statutes. Operational resilience is another essential component of your compliance obligations, specifically through the implementation of a business continuity plan, or BCP. Every investment advisor must establish and maintain a written disaster recovery plan that accounts for both man-made and natural emergencies. This plan must include procedures for back-office recovery, data restoration, and how you will operate if your primary place of business becomes inaccessible. An integral part of the BCP is the protocol for the departure or incapacitation of key personnel, ensuring that firm operations do not grind to a halt should a principal advisor become unavailable. You must keep updated emergency contact information and ensure that remote access protocols are secure to allow for business continuity during disruptions. The documentation must be tested and reviewed periodically to confirm that the firm can meet its obligations to clients even under adverse conditions. Finally, we must address the overarching requirement for internal compliance and oversight. Firms are mandated to conduct an annual compliance review to test the effectiveness of their policies and procedures. This review should be led by a designated compliance officer who holds the responsibility for ensuring the firm remains in strict alignment with legal mandates. If you make material changes to your business, such as shifting your investment style or changing your fee structure, you must update your legal filings promptly. Furthermore, you must provide timely notification to both regulators and your clients whenever these significant changes occur. This proactive approach to documentation maintains the integrity of the registration process and reinforces the advisory firm's commitment to client protection. Keeping these administrative systems in good order is the best way to prevent the oversight errors that often trigger regulatory audits or disciplinary actions. I will see you in the next lecture. Hello, and welcome to this session on supervision and compliance programs. In this chapter, we will examine the regulatory requirements for establishing internal controls, the role of the Chief Compliance Officer, and the essential protocols for oversight within an investment advisory firm. Every registered investment advisor is mandated to establish, maintain, and enforce a robust written compliance manual tailored to its specific business model. This manual is not merely a static collection of policies. It functions as the backbone of the firm's regulatory defense. The firm must appoint a designated Chief Compliance Officer, often referred to as the CCO, who possesses the necessary authority and competence to oversee these internal policies. NASAA regulations explicitly require an annual review of these compliance procedures to ensure they remain effective and aligned with current legal standards. If a firm fails to implement or monitor these controls, it faces significant risks, including the doctrine of vicarious liability, where the firm is held responsible for the actions of its employees. The failure to supervise defense is a specific legal argument used when a firm must demonstrate that it had adequate procedures in place and that it acted reasonably to prevent violations. Ultimately, the effectiveness of a compliance program is measured by the firm's ability to document its actions, proving that supervision is an active, continuous process rather than a passive, check-the-box exercise. Due diligence begins with the hiring process, necessitating thorough background checks and a deep dive into the disciplinary history of any prospective investment advisor representative. Firms must assess whether a candidate has had past regulatory run-ins, as this information is critical for determining suitability and oversight requirements. Once an individual is onboarded, they become subject to rigid monitoring of their personal securities transactions if they are classified as access persons. An access person is defined by their proximity to non-public information or their involvement in the firm's investment decision-making process. These individuals must report their holdings and trades periodically to prevent conflicts of interest, such as front-running client trades. Pre-clearance requirements for initial public offerings and private placements serve as additional safeguards, ensuring that employees do not prioritize personal gain over their fiduciary duties. By institutionalizing these checks, firms create a transparent environment that discourages self-dealing and maintains the integrity of the advisory profession. The solicitation and receipt of gifts can compromise an advisor's objectivity, leading to strict firm-wide policies regarding value limits and disclosure mandates. Any gift, entertainment, or gratuity provided to or received by an investment advisor must be carefully recorded and vetted against predefined corporate thresholds. This is part of a broader need to disclose and manage conflicts of interest, particularly when an advisor engages in outside business activities. An outside business activity, or OBA, requires formal notification and approval from the firm's compliance department before an individual can pursue it. The firm must conduct a formal conflict analysis to determine if the activity creates a risk of harm to clients or interferes with the representative's ability to perform their primary duties. Furthermore, the practice known as selling away, engaging in private securities transactions without written firm permission, is strictly prohibited. Supervisors must ensure that every request for an exception or approval is documented with a clear audit trail, leaving no room for ambiguity regarding the firm's stance on these activities. Supervision is further complicated by the geographic distribution of employees, necessitating specific site inspections for offices of supervisory jurisdiction and smaller branch locations. A branch office is generally defined as any location where one or more representatives regularly conduct business, and it must be subject to a regular, risk-based inspection cycle. Internal audits of these locations must be conducted, focusing on record-keeping, customer complaint handling, and communication styles. When a client submits a complaint, the firm must follow pre-established response timelines, ensuring that the issue is acknowledged, investigated, and addressed in accordance with regulatory requirements. In instances where internal resolution is insufficient, the firm must understand the procedures for mediation and arbitration as mandated by the client agreement. As NASAA standards evolve, particularly regarding remote work arrangements, firms must adapt their cybersecurity policies and provide ongoing training to verify that off-site work does not weaken the oversight of client data. The retention of all supervisory evidence is not just an administrative burden, but a fundamental requirement to prove, during an audit, that the compliance program is functioning consistently across all levels and locations of the firm. See you in the next lecture. Welcome to our exploration of fraud and misrepresentation, a critical chapter for any aspiring investment advisor. We will define the regulatory boundaries of these unethical practices to ensure you can identify and prevent them in your professional practice. Fraud under the Uniform Securities Act is an intentionally broad concept designed to capture any act, practice, or course of business that operates as a deceit upon a client. At the heart of this definition is the concept of scienter, which is the mental state of intent to deceive, manipulate, or defraud. Without this intent, an action might still be negligent or violate other regulations, but it rises to the level of legal fraud only when there is a willful attempt to mislead. This includes not just affirmative false statements, but also the omission of material facts that, if known, would have altered the client's investment decision. Materiality is the objective standard here. We ask whether a reasonable person would have attached importance to the missing or misrepresented information when making their choices. If you omit the risks of a volatile security while highlighting only the potential returns, you're engaged in a form of fraud by omission. Misrepresentation often manifests through exaggerated claims regarding the performance or safety of an investment. You must never guarantee results or promise a specific profit, as all securities markets carry inherent risks that cannot be eliminated. Similarly, using professional titles that imply a certification or qualification you do not possess is a direct violation, as is claiming that the SEC or NASAA has approved your firm's status or the quality of a specific security. Regulators perform registration functions, but they never issue a stamp of approval on the merit of an investment. Providing false statements regarding the financial condition of your firm or an issuer is similarly prohibited, as this information is foundational to an investor's ability to assess counterparty risk. When we discuss indirect fraud, we refer to situations where a professional might benefit from conflicts of interest that remain undisclosed, essentially hiding the true nature of their professional incentives. Market manipulation represents a more technical category of fraud that aims to distort the natural forces of supply and demand. Techniques like wash trades, where an individual creates the illusion of activity by buying and selling the same security among accounts they control, are prohibited. Painting the tape is a similar practice where traders report fake transactions to the public record to give the appearance of heavy volume or rising prices. Matched orders occur when two or more parties coordinate trades to create a deceptive image of market participation. Capping and pegging are practices aimed at influencing the price of a security specifically to benefit an option position or to manipulate the final price of an equity during a specific window. These activities interfere with the integrity of the capital markets and are pursued aggressively by regulators to maintain public trust. The operational side of fraud includes grave offenses such as identity theft, unauthorized withdrawals, and forgery on client documents. An investment advisor has a fiduciary responsibility to protect the assets and data entrusted to them, and any deviation from this constitutes severe misconduct. Forgery, such as signing a client's name on a contract or backdating documents to bypass regulatory deadlines, effectively destroys the professional relationship and creates immediate legal liability. The consequences for these actions are severe and often permanent, including significant fines, civil injunctions, and criminal charges. In many instances, a finding of willful fraud leads to a lifetime bar from the investment advisory industry, a statutory disqualification that prevents the individual from associating with any registered firm. Beyond these penalties, the requirement to provide restitution to harmed clients and the resulting reputational damage often ensure that a career in this field comes to a permanent end. I will see you in the next lecture. Welcome back to our journey through the regulatory landscape. In this session, we will examine the specific prohibited trading practices that form the bedrock of NASAA's enforcement efforts. At the core of the regulatory framework is the expectation that an investment advisor must always prioritize the client's interest over their own gain. Churning is perhaps the most visible violation of this duty, which occurs when a representative induces excessive trading in a client's account primarily to generate commissions. To identify this, regulators look for a pattern where the volume of transactions is inconsistent with the client's stated investment objectives and risk tolerance. It is not just about the number of trades, but rather the underlying intent to inflate the advisor's compensation at the expense of the portfolio's performance. Similarly, executing trades without the proper discretionary authorization is a fundamental breach of trust. Unless a client has signed a formal power of attorney granting such authority, you must receive specific instructions regarding the asset, action, and amount for every single trade. Another category of prohibited behavior involves how orders are handled relative to internal and external information. Front-running happens when an investment professional executes trades for their own account or a preferred client's account ahead of a large client order that is expected to influence the market price. This captures an unfair advantage by utilizing the information of an impending shift in demand. The same ethical principle applies to trading ahead of research reports, where an advisor might trade based on non-public information about an upcoming recommendation. Scalping is a related practice where an advisor recommends a security and then trades against that recommendation to capitalize on the price movement the initial advice created. These acts represent a direct conflict of interest, as the advisor is essentially betting against the very people they are paid to protect. The integrity of mutual fund trading is equally protected by strict prohibitions against market timing and late trading. Market timing involves taking advantage of stale prices in mutual funds to profit from short-term fluctuations, which dilutes the value for long-term shareholders. Late trading refers to placing buy or sell orders after the market is closed, but receiving the price that was set during the trading day. Both practices undermine the fair valuation mechanism of the fund and are explicitly forbidden by regulatory standards. Furthermore, advisors are held to a standard of best execution, requiring them to utilize their knowledge to seek the most favorable terms for their clients. Engaging in interpositioning, which involves inserting an unnecessary third party between the client and the market to generate extra commissions, is a clear violation of this responsibility. Financial dealings between an investment advisor and a client require extreme caution to avoid the appearance of impropriety. Borrowing money from a client or lending personal funds to them creates an inherent conflict of interest that is generally prohibited. The only rare exceptions to this rule apply when the client is a bank, a broker-dealer, or a financial institution that is affiliated with the advisor. Likewise, splitting commissions with an unregistered person is a significant regulatory red flag, as it compensates an entity that does not meet the professional standards mandated for the industry. Selling away or executing trades outside the oversight of the firm leaves the client without the protection of the firm's compliance and supervisory infrastructure. These rules exist because the relationship between an advisor and a client is not a standard commercial exchange, but a professional trust that demands complete transparency and the avoidance of any activity that undermines the client's financial stability. See you in the next lecture. Welcome to this exploration of advisor obligations regarding client recommendations and the fundamental requirement of suitability. We will examine the structured approach necessary to align investment advice with the unique needs and realities of your clients. The cornerstone of the investment advisory profession lies in the knowing the customer principle, which mandates that you gather comprehensive data before formulating any recommendation. This process is not merely a bureaucratic checkbox, but a critical diagnostic phase where you determine a client's financial status, tax bracket, and long-term investment objectives. You must objectively assess their time horizon, which dictates the duration they can afford to have capital locked away, and their liquidity needs, which reflect their requirement for ready cash for unforeseen events. Furthermore, you must evaluate the client's level of investment sophistication to ensure that the complexity of your proposed instruments matches their capacity to understand the underlying risks. Failing to probe deeply into these variables leaves you exposed to claims that your advice lacks a reasonable basis, potentially violating regulatory expectations for suitability. By systematically documenting these inputs, you create a baseline that allows you to defend your professional judgment during any subsequent audit or review. In the practical application of these standards, you must satisfy three distinct prongs of suitability that regulators scrutinize: reasonable basis, customer-specific, and quantitative suitability. Reasonable basis suitability requires that you, as the investment professional, understand the product you are recommending well enough to conclude that it is suitable for at least some group of investors. Customer-specific suitability moves the inquiry to the individual level, ensuring the recommendation fits the specific risk profile and financial situation of the client you are currently serving. Quantitative suitability is the final layer, which requires you to monitor the series of transactions in a client's account to ensure that the pattern of trading is not excessive or incongruent with the account's stated objectives. When these prongs are ignored, you risk placing a client into inappropriate products, such as suggesting complex derivatives or volatile alternative investments to a client with a conservative risk profile. Concentration risk serves as a frequent point of failure when advisors neglect the broader context of a client's overall asset allocation and diversification. A product might look impressive in isolation, but if its addition results in an overconcentration in a specific sector or asset class, you have failed in your duty to construct a balanced portfolio. This is especially prevalent when dealing with niche funds or complex alternative investments that do not correlate neatly with traditional equity and bond markets. You must compare every recommendation against the client's established investment policy statement to ensure that the new position moves the needle toward their goals rather than away from them. If a client refuses to provide necessary information, you must document that refusal clearly and consider whether you can continue to advise them without a complete picture of their financial life. Ongoing monitoring is essential because life events, such as marriage, retirement, or the sudden loss of income, can render previously suitable investments entirely inappropriate overnight. One area that requires heightened vigilance is the protection of senior investors and those potentially experiencing diminished mental capacity. Regulators have established specific protocols for identifying elder abuse, which includes emotional, physical, or financial exploitation that often manifests as unusual or high-pressure activity in an account. As an advisor, you must avoid high-pressure tactics that force a client into a commitment before they have the time to process the implications of the trade. If you suspect that a client is no longer capable of managing their own affairs, you should utilize the tools provided by your firm, such as identifying a trusted contact person. Your communication must remain transparent and balanced, avoiding overly optimistic projections that ignore the potential for downside loss. Remember that your primary role is that of a fiduciary, which demands that you place the client's interests ahead of your own at all times, regardless of the commissions or fees involved. Documentation remains the ultimate defense for the professional advisor who takes their regulatory burden seriously. You should make it a habit to record the rationale behind every significant recommendation, noting why you believe the specific asset aligns with the client's known objectives and risk tolerance. If a client insists on an order type or strategy that contradicts your institutional advice, such as opting for aggressive market orders rather than protective limit orders during period of high volatility, you must note that conversation in your records. These notes serve as your primary evidence that you conducted a thorough analysis and adequately informed the client of the associated risks before executing their instructions. By establishing a culture of systematic documentation, you transition from simply being a person who provides tips to becoming a disciplined professional who manages risk and adheres to the ethical standards of the industry. This level of rigor is what differentiates experienced advisors from those who remain vulnerable to regulatory scrutiny. See you in the next lecture. Welcome to our exploration of managing conflicts of interest, a critical area where your integrity as an investment advisor is tested against professional standards. When we talk about conflicts of interest in the realm of the Series 65 exam, we are primarily dealing with the principle of transparency. As an investment advisor, your primary duty is to act in the best interest of your client, which necessitates that any situation where your interests might conflict with theirs must be identified, disclosed, and managed. Revenue sharing arrangements or third-party compensation, such as payments for soliciting clients, create an inherent tension between the advice you provide and the financial gain you may receive from a specific third party. You must disclose these payments clearly, typically through the Form ADV Part 2, to ensure that the client understands the economic biases that might inform your recommendations. If you recommend a proprietary product or favor certain products because they provide your firm with higher commissions, you're wandering into dangerous territory that demands rigorous disclosure of these incentivized sales quotas. Non-cash compensation, including gifts, travel, and entertainment, is often scrutinized because it can cloud objective judgment. The regulation surrounding soft dollar arrangements under Section 28E provides a safe harbor, but this only applies if the research obtained with commission dollars benefits the client and is considered reasonable in relation to the commissions paid. This exclusion allows advisors to pay for investment research, but it strictly separates this from overhead expenses, which must be paid by the firm. If you use soft dollars to pay for computer hardware or office furniture, you are violating these rules, as those are administrative overhead expenses rather than research services. Managing these arrangements requires careful documentation to distinguish between legitimate research that aids in your fiduciary duties and prohibited expenses that merely reduce your firm's operating costs. Executing trades introduces its own set of unique conflicts, particularly regarding principal trading and agency cross-transactions. A principal trade occurs when an advisor acts as a dealer for its own account to sell a security to a client, which requires specific disclosure and informed consent from the client prior to the completion of the transaction. Similarly, an agency cross-transaction requires the advisor to act as both agent for the client and for the other party involved in the trade, necessitating written disclosure of the arrangement and consent before the execution. You must be hyper-aware of the dangers of front-running, where an advisor places orders for their own account ahead of client orders to gain an unfair price advantage, which is a severe violation of ethical conduct. To mitigate these risks, firm policies often mandate a strict code of ethics that outlines procedures for personal trading, typically requiring pre-clearance and reporting to ensure that the advisor's personal interests never precede those of their clients. Side-by-side management of multiple client portfolios frequently leads to questions about the allocation of investment opportunities. When a limited investment opportunity arises, such as a hot initial public offering or a small-cap stock with limited liquidity, you must ensure fair and equitable treatment across all accounts you manage. A standard approach here is to utilize a pro rata allocation strategy, which ensures that each account receives a proportionate share of the security based on their portfolio size or investment mandate. You must always document the reasoning behind these allocations to demonstrate that your process is objective and not preferential to larger or more profitable accounts. This level of rigor reinforces the client's trust in your advisory role, ensuring that your firm's affiliations or relationships with issuers do not influence your allocation decisions. Conflicts also arise from outside business activities, such as serving on the board of a corporation whose securities you might recommend to clients. If a family member is employed by a firm you frequently trade with, or if you maintain board memberships elsewhere, these must be disclosed as significant conflicts of interest. The goal is to provide the client with sufficient information to evaluate the objectivity of your advice, acknowledging that personal relationships can inadvertently sway professional judgment. Effective mitigation strategies involve internal firewalls that prevent the flow of sensitive information between departments and independent review committees that assess potential conflicts before they manifest into a breach of fiduciary duty. Maintaining comprehensive standard operating procedures for conflict resolution is not optional. It is the backbone of a compliant firm that respects the requirement for informed client consent. Keep reviewing these concepts to ensure your understanding remains sharp. See you in the next lecture. Welcome to this exploration of brokerage and custodial misconduct, where we refine our understanding of the integrity required by the Uniform Securities Act. In this lesson, we will dissect the specific regulatory boundaries that separate legitimate financial conduct from prohibited practices. One of the most fundamental requirements under NASAA regulations is the absolute segregation of firm assets and client funds. Commingling, or the act of mixing a customer's money or securities with the broker-dealer's proprietary accounts, is a strict violation that undermines the fiduciary trust inherent in the relationship. This rule extends beyond mere bank deposits to the physical handling of security certificates. When a firm takes possession of client certificates, they must be stored in a manner that ensures they remain distinct and identifiable as the client's property at all times. Improper custody of checks, such as holding a client's check for an unreasonable period or depositing it into the wrong account, serves as a primary red flag during any regulatory audit. You must understand that even if no financial loss occurs to the client, the act of failing to maintain this physical and financial separation is, in itself, a violation of the law. Moving into the execution of trades, firms and their representatives must strictly adhere to the scope of their authority. Exceeding discretionary limits without obtaining prior written authorization is not merely a procedural oversight. It is a breach of the contractual relationship between the advisor and the client. Similarly, the obligation to deliver prospectuses on time is a core regulatory burden, as this document provides the essential information required for an informed investment decision. When we look at transaction costs, the mandate for transparency regarding markups and markdowns is non-negotiable. Charging unreasonable fees or failing to disclose the firm's status as a market maker creates a hidden bias that misleads the client during the trade execution process. These disclosures are designed to ensure that the client understands exactly who is on the other side of their transaction and how the firm is being compensated for that service. Conflicts of interest often manifest in the form of undisclosed outside business activities, commonly referred to as selling away. This practice, where a representative affects securities transactions outside the scope of their firm's knowledge or supervision, is strictly prohibited because it bypasses the compliance oversight that protects investors. Beyond these transaction-based behaviors, there's a recurring requirement for administrative transparency. Any shift in the firm's operational status, such as a change of address, a name change, or any material update impacting the firm's registration, must be reported to the state administrator promptly. The regulatory authority is granted significant power, and any disregard for a cease and desist order or attempting to operate while under suspension are severe infractions that lead to permanent loss of registration. These administrative rules exist so that the regulator always knows exactly who it is overseeing and whether those entities are currently authorized to conduct business with the public. The burden of oversight falls squarely on the firm through the requirement for consistent supervision of its agents. The firm is held to both direct and indirect liability for the actions taken by its representatives, meaning that a lack of supervision is a legal exposure in its own right. This compliance function relies heavily on the maintenance of accurate books and records, which provide the audit trail necessary for verifying that all firm activities conform to legal standards. The intentional destruction of evidence required for audits is treated with the highest degree of severity by the NASAA. Furthermore, the use of misleading marketing materials, particularly those suggesting an affiliation or endorsement that does not actually exist, is a deceptive practice intended to leverage the firm's reputation unfairly. Every aspect of this operational landscape is designed to ensure that the client is not only protected from fraud, but is also provided with a fair, transparent environment in which to invest their capital. I look forward to our next deep dive into the remaining regulatory nuances. Welcome back. In this lecture, we examine the complexities of insider trading and market abuse, focusing on the regulatory safeguards that maintain market integrity. Insider trading is fundamentally the misuse of material non-public information to gain an unfair advantage in the securities markets. Information is considered material if there is a substantial likelihood that a reasonable investor would consider it important in making an investment decision. It is non-public if it has not been disseminated to the broader market in a way that allows the public to react. The landmark case of Natanson v. United States and the development of the misappropriation theory have helped define the scope of liability here. Under this theory, a person commits fraud by misappropriating confidential information for securities trading purposes in breach of a duty owed to the source of that information. Prohibitions extend beyond traditional corporate insiders to include constructive insiders like accountants, lawyers, and consultants who possess sensitive data. The cornerstone of the personal benefit test, established through various judicial precedents, requires that the tipper must receive some form of benefit, which can be financial or even just a reputational gain or a gift of information to a friend. The legislative response to these abuses is robust, particularly through the Insider Trading and Securities Fraud Enforcement Act, known as ITSFEA. This act empowers regulators to impose severe sanctions, including civil penalties that can reach 3 times the profit gained or loss avoided, often referred to as treble damages. Beyond these financial burdens, individuals face significant criminal fines and lengthy prison terms for violations. To mitigate these risks, organizations must implement rigorous procedures, specifically information barriers often called ethical walls, to prevent the flow of sensitive information between departments. Firms are required to monitor employee trading activity and maintain restricted or watch lists for securities that fall under intensive scrutiny due to current non-public projects. These procedures serve as a defense mechanism to demonstrate that the firm has taken reasonable steps to prevent illicit activity. Market manipulation represents a broader category of misconduct designed to artificially influence the price or volume of securities. Tactics such as wash sales, where no change in beneficial ownership occurs, or matched orders, where buy and sell orders are coordinated to create the illusion of active trading, are strictly prohibited. Cornering the market involves accumulating enough of an asset to control its price, while marking the close or marking the open involves executing trades at the very end or beginning of a session solely to influence the reported price. Other harmful practices include spread distortion, collusive trading, and the dissemination of false rumors via social media to facilitate pump and dump schemes. Regulators respond to these threats through sophisticated surveillance techniques, including comprehensive trade reconstruction and analysis. They frequently subpoena communication logs and cooperate closely with the SEC and FINRA to catch offenders. State administrators also play a critical role in enforcing these standards to ensure professional objectivity and protect the broader investing public. See you in the next lecture. Welcome to our exploration of investment styles and strategies. We will dissect how different philosophies influence portfolio construction and the tactical frameworks used by investment advisors to pursue client objectives. Investment management often bifurcates into active and passive strategies, a distinction rooted in the underlying belief regarding market efficiency. Active management relies on the premise that an analyst can consistently identify mispriced securities to achieve alpha, which is the excess return of an investment relative to the return of a benchmark index. Conversely, passive management assumes that information is efficiently reflected in prices, leading many practitioners to utilize index investing. Proponents of the efficient market hypothesis argue in its weak form that technical analysis offers no advantage, while the semi-strong form suggests that even fundamental analysis is already baked into security prices. The strong form, though rarely accepted in practice, implies that no investor can consistently outperform the market, even with non-public information. This spectrum of belief fundamentally dictates whether an advisor spends client capital on research departments or low-cost tracking funds. When we look deeper into security selection, we encounter the dichotomy between value and growth investing. Value investors act as bargain hunters, seeking out equities they believe are undervalued by the market based on fundamental analysis. They often look for low price-to-earnings ratios, significant dividend yields, and depressed price-to-book valuations, effectively attempting to buy a dollar for 80 cents. Growth investing, meanwhile, focuses on the potential for future expansion in earnings and revenue rather than present dividends. These investors hunt for companies with high growth momentum, often accepting high valuations today in anticipation of exponential gains tomorrow. Both styles require disciplined monitoring, as an investor must guard against style drift, which occurs when a fund or strategy deviates from its stated investment objective. Staying true to a defined style prevents unnecessary risks that could emerge if a value-oriented portfolio accidentally accumulates speculative high-growth assets. Strategic and tactical asset allocation represent different approaches to managing portfolio exposure over time. Strategic asset allocation typically involves setting a fixed policy mix, often based on long-term risk tolerance, which the advisor maintains through periodic rebalancing. This rebalancing might utilize constant ratio methods, keeping specific percentages of stocks and bonds, or constant dollar amounts, which forces a sell high and buy low discipline. Tactical asset allocation is inherently more transient, as it allows the advisor to deviate from the long-term target to take advantage of temporary market mispricing. A more sophisticated hybrid is the core satellite approach, where a firm anchors its portfolio in diversified, low-cost core holdings while surrounding them with smaller, specialized satellite positions meant to generate alpha. These decisions are frequently informed by either top-down analysis, which considers broad economic cycles first, or bottom-up analysis, which prioritizes the health of individual firms. Modern portfolio theory provides a mathematical foundation for these strategic choices, emphasizing that risk is not merely an individual security characteristic, but a function of portfolio composition. Through the lens of the capital asset pricing model, we assess expected returns based on the risk-free rate plus a risk premium determined by beta. Beta measures the volatility of an asset relative to the overall market, serving as a proxy for systemic risk that cannot be diversified away. By combining assets with low or negative correlation, an advisor can reduce non-systemic or idiosyncratic risk, effectively moving the portfolio toward the efficient frontier. While the security market line depicts the expected return of an individual asset, the capital market line illustrates the risk-return trade-off for efficient portfolios. Understanding these relationships allows an advisor to communicate to clients that while some risk is rewarded, diversifiable risk is simply an avoidable error. Fixed income strategies add another layer of nuance when considering total return versus simple income generation. Advisors may use specific bond techniques, such as laddering, where securities are purchased with staggered maturities to smooth out interest rate risk and provide consistent liquidity. Alternatively, a barbell strategy combines short-term and long-term bonds to balance reinvestment risk with capital appreciation, while bullet strategies concentrate maturities around a specific future date. When market conditions shift, sector rotation strategies or thematic investing may be employed to tilt the portfolio toward industries expected to outperform during specific economic phases. Advisors must also be cognizant of transaction costs, as frequent turnover in tactical strategies can rapidly erode the net returns that are so vital to compounding wealth over a client's lifetime. Each of these decisions requires a rigorous adherence to the client's original investment policy statement to ensure that the chosen strategy remains aligned with their long-term goals. See you in our next session. Welcome back as we begin our exploration of modern portfolio theory, a cornerstone of how we analyze investment efficiency. We will establish the mathematical foundations of risk and return to help you pass the exam. Modern portfolio theory, pioneered by Harry Markowitz, fundamentally changed how we construct portfolios by advocating that an investment should not be evaluated in isolation. Instead, the focus shifts to how an individual asset contributes to the total portfolio's risk and return profile. The core premise is that if you combine assets that are not perfectly correlated, you can reduce overall portfolio risk without necessarily sacrificing expected returns. This process relies on diversification, which targets the elimination of unsystematic risk. Unsystematic risk, often called business or specific risk, is inherent to a particular company or industry and can be managed through asset selection. Systematic risk, conversely, is the market risk that remains despite your best diversification efforts, affecting the entire market simultaneously. By utilizing mean variance analysis, investors aim to reach the efficient frontier, which represents the set of optimal portfolios providing the highest expected return for a defined level of risk. To measure this risk, we rely on standard deviation, which acts as our primary metric for volatility. Variance is simply the square of standard deviation, but in practice, we usually discuss volatility in terms of standard deviation to maintain consistency with historical data. We also examined the correlation coefficient, a value ranging from -1 to +1, to understand how assets move relative to each other. A correlation of -1 suggests assets move in opposite directions, providing excellent risk reduction, whereas a +1 indicates they move in lockstep. Zero correlation means there is no linear relationship between them at all. Understanding the covariance between assets is the engine beneath these correlations, as it quantifies how two assets change together. When you apply these concepts, you can effectively manage the portfolio's total volatility, provided you keep your assumptions regarding asset distributions grounded. Beta is the tool we use to measure an asset's sensitivity to market movements compared to the broader market index. A beta of 1 implies the asset moves in perfect alignment with the market, while a beta greater than 1 implies higher volatility, and a beta less than 1 suggests lower sensitivity. This leads us directly to the capital asset pricing model, or CAPM, where we calculate the expected return by taking the risk-free rate and adding the equity risk premium adjusted by the asset's beta. This model assumes that investors are compensated only for systematic risk, as unsystematic risk can be diversified away. Consequently, the security market line, or SML, visualizes this relationship, plotting expected return against beta. If an asset plots above the SML, it is considered undervalued because it offers a higher return than its systematic risk would suggest. If it plots below, it is overvalued. When we assess portfolio performance, we often look beyond simple returns to risk-adjusted metrics like the Sharpe Ratio and the Trainer Ratio. The Sharpe Ratio measures the excess return per unit of total risk, using standard deviation as the denominator, which is fitting for portfolios that are not fully diversified. The Trainer Ratio, however, uses beta as the denominator, which is more appropriate when evaluating portfolios that are already well diversified. Jensen's alpha further refines this by calculating the difference between the actual return achieved and the return predicted by the CAPM formula. A positive alpha indicates the manager has added value through superior selection or timing relative to the systematic risk taken. These tools allow us to move along the capital market line, where the optimal portfolio is found based on the investor's specific risk aversion and utility curves. While the math is elegant, we must acknowledge the limitations inherent in these models, particularly the assumption that returns follow a normal distribution. In the real world, we frequently encounter fat tail risks where extreme events occur far more often than bell curve statistics would predict. These occurrences, sometimes called black swan events, represent the failure of MPT during periods of market panic when correlations often spike toward 1. Despite these flaws, MPT remains the industry standard for strategic asset allocation because it provides a necessary framework for aligning client risk tolerance with their investment holdings. As an advisor, your job is to translate these technical concepts into recommendations that respect both the theoretical model and the messy reality of global markets. Understanding these foundations will serve you well when evaluating the suitability of various assets for your future clients. I will see you in the next lecture. Welcome to our examination of financial risks. In this chapter, we will dissect the various components of risk that every investment advisor must identify and manage for their clients. Risk is the fundamental trade-off in finance, reflecting the uncertainty of achieving a projected return. When we categorize risk, we first distinguish between systematic and unsystematic factors. Systematic risk, often called market risk, represents the inherent volatility of the entire market that cannot be mitigated through diversification. Interest rate risk is the most prominent form of systematic risk for fixed income securities. As interest rates rise, bond prices fall because their fixed coupons appear less attractive compared to new issues paying higher yields. This inverse relationship is a cornerstone of your understanding of market mechanics and asset pricing. While you cannot diversify away systematic risk, you must ensure that a client's portfolio is positioned to withstand these broad economic fluctuations. Inflation risk, also known as purchasing power risk, represents the danger that the real value of an investment's cash flows will decline over time due to rising prices. This is particularly problematic for long-term fixed income investments where the coupon payments remain static while the cost of living increases. Business risk and financial risk are primary examples of unsystematic risks that specifically affect an individual company or sector. Business risk revolves around the operational success of a firm, while financial risk is associated with the company's capital structure and its burden of debt. Credit or default risk is the possibility that an issuer will be unable to pay interest or principal on its obligations, requiring investors to monitor credit spreads, which are the yield premiums demanded by investors for holding non-government bonds. Liquidity risk or marketability risk is the hazard of being unable to sell an asset quickly without significant price concessions. This is often a trap for investors holding thinly traded municipal bonds or private placements. Regulatory, legislative, and political risks arise from changes in government policy, tax laws, or shifting international landscapes that can suddenly invalidate an investment thesis. Currency or exchange rate risk impacts portfolios with international exposure, as fluctuations in foreign exchange values can erode gains even if the underlying security performs well. Opportunity cost is a subtle but critical risk representing the foregone return from choosing one investment over another. Reinvestment rate risk becomes especially important for bond ladders. If interest rates decline, the cash flows from maturing bonds must be reinvested at lower prevailing rates, lowering the average portfolio yield. Call risk and prepayment risk are closely linked to the behavior of mortgage-backed securities and callable bonds. When interest rates drop, issuers often act rationally by refinancing their debt, forcing investors to take back their principal earlier than anticipated. Those investors then face the aforementioned reinvestment risk, highlighting how different risks often interact within a single security. Sovereign risk adds another layer of complexity for international investors, as it involves the stability of a foreign government's ability and willingness to meet its financial obligations. You must calculate these risks using metrics like standard deviation to measure volatility and duration to quantify interest rate sensitivity. Macaulay duration measures the weighted average time to receive cash flows, whereas modified duration offers a linear estimate of price change based on interest rate moves. Convexity is a vital tool for understanding the curvature of the price-yield relationship of a bond, which modified duration fails to capture fully. When assessing client needs, you must differentiate between risk tolerance, which is psychological, and risk capacity, which is the objective ability to absorb losses. A young investor might have a high risk capacity due to a long time horizon, even if they are temperamentally risk-averse. Conversely, an older client might have a high willingness to take risks but low capacity due to immediate cash flow needs. Prudence dictates that you balance these factors while ensuring that communications are not misleading. Never portray historical performance as a guarantee of future reality, and always be transparent about potential downsides. Understanding these concepts allows you to build robust portfolios that align with the client's actual economic requirements versus their subjective outlook. See you in the next session. Welcome to the exploration of macroeconomics and its profound influence on the financial markets. In this chapter, we will dissect the fundamental economic indicators and policies that drive asset valuation and investor sentiment. Macroeconomics serves as the backdrop for all security analysis, and understanding its mechanisms is essential for any serious investment advisor. Gross domestic product, or GDP, represents the total monetary value of all finished goods and services produced within a country's borders in a specific period. When we talk about real GDP, we are adjusting these figures for inflation, providing a clearer picture of actual economic growth compared to nominal GDP, which uses current market prices. This distinction is vital because a rising nominal figure might simply reflect price increases rather than a true expansion of output. We typically break down GDP into four distinct components: consumption, investment, government spending, and net exports. Consumption is generally the largest driver of economic activity in the United States, reflecting the aggregate spending habits of households on goods and services. Investment, in this context, refers to business capital expenditures, such as new equipment or facilities, rather than personal stock market activity. Government spending captures the public sector's role in the economy, while the trade balance, or net exports, account for the difference between what a nation sells abroad and what it imports. The government influences these metrics through fiscal policy, which primarily involves tax adjustments and changes in the level of government spending. If the government decides to increase spending or cut taxes, it generally aims to stimulate economic activity, potentially leading to a larger deficit if revenues do not keep pace. Conversely, raising taxes or reducing spending can dampen aggregate demand, which is often a strategy used to combat high inflation or to reduce national debt levels. Debt itself is the cumulative result of annual deficits, and the management of this debt has significant repercussions for future interest rates and public policy flexibility. Crucially, as an investment advisor, you must recognize that fiscal policy, while impactful, often moves slowly through the legislative process, making its effects somewhat predictable but often lagged in the real-world market ecosystem. Understanding the interplay between taxation, spending, and the resulting debt levels allows you to better anticipate how government actions might tilt the playing field for various sectors of the economy. While the government manages the fiscal side, the Federal Reserve takes the lead in monetary policy to regulate the economy's money supply and interest rates. The primary tools at the disposal of the Federal Reserve include adjusting reserve requirements, setting the discount rate, and engaging in open market operations. By buying or selling government securities, the central bank influences the federal funds rate, which is the interest rate at which depository institutions trade federal funds with each other overnight. An increase in this rate generally cascades through the broader economy, raising the cost of borrowing for both businesses and consumers, which typically slows economic activity. Inflation measures, such as the Consumer Price Index and the Producer Price Index, act as the Federal Reserve's primary signals for when to tighten or loosen these policies. High or rising inflation often mandates a tighter monetary stance to maintain price stability, whereas deflation or stagnant growth, sometimes called stagflation, presents a more complex set of challenges for policymakers. Economic cycles consist of distinct phases: expansion, peak, contraction, and trough, each offering unique environments for different investment vehicles. We monitor these cycles using leading, coincident, and lagging indicators to gauge where we stand in the sequence. Leading indicators, such as building permits or stock market performance, hint at future economic moves, while coincident indicators like personal income reflect current activity. Lagging indicators, such as the average duration of unemployment, confirm trends only after they have manifested. Investors pay particular attention to the yield curve, which maps the interest rates on bonds of varying maturities. A normal, upward-sloping curve is standard, while an inverted yield curve, where short-term rates exceed long-term ones, historically acts as a reliable precursor to a recession. Recognizing these shifting signals is not just about academic interest. It directly impacts how you categorize stocks as cyclical or defensive. Cyclical sectors, such as consumer discretionary or industrials, tend to thrive during periods of economic expansion, whereas defensive sectors like utilities or healthcare maintain steady performance during contractions. This differentiation is the foundation of market indices like the Dow Jones, the S&P 500, or the Russell 2000, which track various segments of the equity landscape. Global market indices also provide a view of international risks, with exchange rates playing a critical role in the profit margins of multinational corporations. A strong domestic currency, for example, makes exports more expensive for foreign buyers, which can negatively affect domestic companies with significant international revenue. Furthermore, data sets like unemployment rates, specifically the distinction between the U.S. Bureau of Labor Statistics U3 and U6 metrics, and housing starts provide granular insight into the health of the labor and real estate markets. All these factors ultimately flow into valuation models, such as the discounted cash flow analysis, where interest rates act as the denominator to determine the present value of future cash flows, setting the stage for how we price fixed income and equity securities. See you in the next lecture. Welcome back. Today we are delving into the fundamental task of determining what a stock is actually worth. In this chapter, we will systematically break down the equity valuation methods and quantitative tools necessary for your success. When we approach the valuation of equity securities, we must first grapple with the core philosophy that a stock's market price does not always reflect its intrinsic value. As an investment advisor, your role is to cut through market noise by utilizing quantitative analysis to derive a fair valuation based on the company's financial health and future earnings potential. We begin this process with financial statement analysis, which serves as the data foundation for all downstream calculations. A balance sheet gives us a snapshot of a firm's assets, liabilities, and shareholder equity at a specific point in time, while the income statement provides the flow of revenue and expenses that lead to net income. By examining liquidity metrics like the current ratio or the quick ratio, we can immediately gauge whether a company has sufficient resources to cover its short-term obligations. Furthermore, solvency measures such as the debt-to-equity ratio tell us about the long-term leverage and the associated risks embedded in the capital structure. Without this primary understanding of how the company is financed and how it generates profit, Any further attempts at valuation would be akin to building a house on a foundation of sand. Once the financial statements are understood, we generally shift our focus towards specific valuation ratios that allow for the comparison of securities across different industries. The price-to-earnings ratio is perhaps the most ubiquitous, as it relates the current market price of stock to its earnings per share, providing an immediate sense of how much investors are willing to pay for each dollar of annual profit. Similarly, the price-to-book ratio offers insight into how the market values the company relative to its net asset value, often signaling whether a stock is categorized as value or growth. We must also consider the dividend yield and the payout ratio, which together illustrate how a company returns value to its shareholders and whether those dividends are sustainable. However, remember that these ratios are merely historical indicators. They provide context but do not necessarily predict future performance or guarantee a margin of safety. When analyzing earnings per share, be particularly mindful of the distinction between basic earnings and fully diluted earnings, as the latter accounts for all convertible securities that could potentially diminish shareholder value over time. Moving beyond static ratios, we arrive at the more granular discounted cash flow analysis, which attempts to calculate the present value of a company's future projected cash flows. This method requires us to estimate a growth rate and select an appropriate discount rate, typically the weighted average cost of capital, to account for the time value of money and the inherent risk of the investment. A central component here is the terminal value, which account for the vast majority of a company's total valuation in these models by representing the value beyond the explicit projection period. Because the accuracy of these models is highly sensitive to the initial growth assumptions and the discount rate applied, a small error in input can lead to a significant divergence in output. This is precisely why savvy analysts emphasize the concept of a margin of safety, which acts as a buffer between the intrinsic value they have calculated and the prevailing market price of the security. By adhering to this disciplined approach, you diminish the likelihood of overpaying for an asset, even if your projections happen to be slightly off the mark. In addition to intrinsic valuation models, we must recognize the role of corporate actions and market dynamics that can influence equity prices independently of fundamental performance. Stock splits and buybacks, while not altering the fundamental economic value of the business, frequently impact the perceived value and the supply and demand equilibrium for the stock in the marketplace. While splits simply adjust the number of shares and the corresponding price per share, share repurchases reduce the total supply of stock, which can artificially support earnings per share metrics and influence market sentiment. Finally, we should briefly consider the efficient market hypothesis, a theory suggesting that at any given time, market prices fully reflect all available information. While this is an academic construct, it provides a crucial counterweight to fundamental analysis, forcing us to ask how much of a perceived mispricing is actually an undiscovered opportunity versus a difference in interpretation of public data. Balancing these competing views is essential to providing sound, evidence-based advice to your clients as they navigate equity markets. See you in the next session. Welcome back. In this chapter, we will dissect the mechanics of fixed income securities and the analytical methods used to value them accurately for your upcoming exam. When analyzing a bond, we must first master the fundamental components: the par value, which is generally $1,000, the coupon rate, and the maturity date. The coupon rate determines the annual interest payment, while the current yield is derived by dividing the annual coupon payment by the current market price of the bond. Yield to maturity represents the total expected return if held until the terminal date, accounting for the difference between the purchase price and the par value received at maturity. Unlike current yield, the yield to maturity reflects the internal rate of return, effectively discounting all future cash flows to the present value. When a bond trades at a discount, its current yield and yield to maturity are higher than the coupon rate. Conversely, premium bonds exhibit lower yields than their stated coupon rates due to the capital loss experienced as the bond approaches its par value at maturity. Understanding the inverse relationship between bond prices and interest rates is essential for any investment professional. When market interest rates rise, the price of existing bonds inversely declines to maintain parity with new issuances. Duration serves as our primary metric for quantifying this price sensitivity, specifically identifying how much a bond price will fluctuate given a 100 basis point change in interest rates. Macaulay duration measures the weighted average time until all cash flows are received, whereas modified duration offers a more direct percentage change estimation for a given yield shift. Convexity complements duration, acting as a secondary derivative to measure the curvature in the price-yield relationship when duration approximations become less accurate. This framework allows us to estimate potential volatility in a bond portfolio. Credit analysis requires evaluating the capacity of the issuer to meet contractual obligations through the lens of rating agencies like Moody's, Standard & Poor's, or Fitch. Investment-grade securities are characterized by lower default risk, whereas high-yield, or junk bonds, compensate investors with higher spread for taking on significant credit risk. Corporate bonds carry these credit risk premiums, while Treasury securities are backed by the full faith and credit of the government. Treasury bills, notes, and bonds differ in maturity, with Treasury inflation-protected securities known as TIPS providing a hedge against inflation by adjusting the principal value. Strips, on the other hand, are stripped of their interest payments and sold as zero-coupon instruments, removing reinvestment risk entirely. Municipal bonds offer their own unique landscape, categorized primarily as either general obligation bonds or revenue bonds. General obligation bonds are secured by the taxing power of the municipality, whereas revenue bonds are serviced solely through the earnings of the specific project financed. When comparing these to taxable corporate bonds, we utilize the tax equivalent yield calculation to determine if the municipal tax exemption provides a net benefit to the client. Money market instruments, including commercial paper, repurchase agreements, and certificates of deposit, provide liquidity rather than long-term capital appreciation. These instruments are highly stable, though their low yields are often barely sufficient to offset inflation over long horizons. Valuing fixed income securities relies heavily on discounting future cash flows at appropriate spot rates, which are the yields on zero-coupon bonds of various maturities. Forward rates, derived from the current spot rate curve, provide expectations for future market pricing. Embedded options, such as call provisions, allow issuers to redeem bonds early, typically when rates fall, which creates reinvestment risk for the holder. Put provisions, conversely, offer the investor the right to sell the bond back, providing a measure of protection against rising rates. Convertible bonds introduce complexity by allowing the holder to convert the debt into a specified number of equity shares, determined by the conversion ratio and parity price calculations. Finally, we arrive at structured products like mortgage-backed securities and collateralized mortgage obligations, which distribute interest and principal cash flows into various tranches. These tranches often have different risk profiles, with some prioritizing principal repayment and others isolating interest income, known as interest-only or principal-only tranches. The liquidity premium is the additional yield investors demand for holding assets that are difficult to convert to cash without significant price impact. Default spreads measure the additional yield over treasuries required to compensate for the probability of non-payment. Mastering these concepts ensures you can accurately assess the risk-return profile of even the most complex fixed income instruments you may encounter in your practice. I will see you in the next lecture. Welcome to our final module, where we will synthesize everything we have covered into a cohesive strategy for your success. We will consolidate legal frameworks, ethical mandates, and technical concepts to ensure you are fully prepared for the exam. To reach mastery, you must first consolidate the legal definitions we explored early in this course, specifically regarding the Uniform Securities Act and the model rules established by NASAA. You should already have a firm grasp of the distinction between an investment advisor and a broker-dealer. But now is the moment to internalize the specific federal and state registration thresholds. Recalling these numbers is not a matter of pure rote memorization, but rather understanding the regulatory intent behind them regarding investor protection. Remember that the fiduciary duty you owe as an investment advisor is a continuous obligation that transcends simple document delivery or disclosure requirements. Throughout this final review, look for the underlying principles that connect ethical conduct to your professional responsibilities. If you find yourself struggling with the specifics of the brochure rule or document retention periods, revisit your internal summaries to ensure these timelines are clearly mapped. This level of precision is exactly what NASAA examiners look for when they frame their most challenging scenarios. By structuring your knowledge this way, you move from merely knowing the rules to being able to apply them dynamically under pressure. Strategic mindset is your strongest tool when navigating the technical portions of the exam, particularly concerning risk metrics and valuation formulas. You have spent time learning how to balance modern portfolio theory with practical investment strategies, and now you must apply that theory to real-world scenario analysis. When faced with calculations regarding fixed income or equity valuation, focus on identifying the variables provided versus the variables requested before you attempt any mental arithmetic. If you encounter a complex valuation question, take a moment to classify the risk type involved, such as systemic versus unsystematic risk, as this often narrows your answer choices immediately. Understanding the core concept behind a formula often serves you better than just memorizing the formula itself, as it allows you to sanity check your results. As you integrate the material from your earlier studies, you will likely notice that themes of suitability and conflict management appear consistently across different modules. Treat these intersections as opportunities to reinforce your understanding rather than as repetitive information. Consistency in your application of these concepts is the primary indicator of your readiness for the final assessment. Exam taking technique involves more than just factual recall, as it requires you to actively manage your time and your psychological approach to difficult questions. You should approach the exam as a series of distinct encounters where you must constantly identify distractors within the prompt itself. NASAA often includes extraneous data intended to pull your focus away from the core legal or ethical constraint being tested. So practice reading the final sentence of each question first to understand exactly what is being asked. If you find yourself spending more than a set amount of time on a single problem, apply a triage approach by marking it, selecting your best guess, and moving on to preserve your momentum. Building confidence during the exam comes from effectively managing your pacing, which prevents the cognitive fatigue that often leads to avoidable errors late in the session. Do not let one difficult question dictate your performance for the entire block, as every question holds equal weight in your final scoring. Trust the rigorous preparation you have put in, and use your time to ensure that you're answering the questions the examiners are actually asking rather than the ones you might be predicting. As you look toward the post-exam environment, ensure you are familiar with the logistics of the testing center and the specific identification requirements needed for admission. Understanding the path forward, including U4 maintenance and the ongoing expectations of continuing education, provides a professional context that helps you view these exams as part of a larger career life cycle. Your responsibilities as a licensed professional do not end when you pass the exam, but rather begin a process of compliance that requires constant vigilance. Keep in mind that documentation and oversight are the bedrock of your advisory career, and your current dedication to these study materials is a reflection of the diligence you will provide to your future clients. Maintain a steady focus on your objective, and ensure that your final preparation is focused on strengthening your identified weak areas rather than just skimming what you already know well. You have developed the necessary skills to navigate the regulatory landscape and the technical competencies to manage client expectations effectively. Carry this structured approach into the examination room, and focus on the logical consistency of your answers throughout the session. I wish you the best of luck with your final preparations and success on your examination.